Welcome back. Continuing to track the market, which is now looking at a cut of about 1%, but its macros in focus now. Two separate issues to tackle here. One is, of course, the RBI dividend, which came through last week, and it's a large dividend payout once again, 2.69 lakh crore rupees. That's how much the Reserve Bank of India will be transferring to the government for the fiscal year. Now, this is about 27% higher than what the RBI had transferred to the government in FY24. Not just that, remember that next week is the monetary policy. The MPC meeting happens and the announcement is all set for, I think, the 6th of June, which is next Friday, basically. So let's talk about all the macro developments now. Sakshi, Gupta, VP and Senior Economist at HDFC Bank, as well as Upasna, Bhardwaj, Chief Economist at Kotak Mahindra Bank, are with us. Ladies, great to have you. Thanks very much for joining in. So let's tackle the dividend piece first. Upasna, so, what do your numbers say? The fact that the dividend is higher than last year, it's not as high as what the street was estimating. Estimates were floating of around 3 lakh crores, 3.5 lakh crores. But given what it is, what is the kind of fiscal headroom it opens up for the government, and where do you think the money could be spent?
So here we need to keep into account two things. One, in the beginning of the year, we had also highlighted then that the direct tax collections seem a little optimistic in terms of growth because the income tax cuts were announced. And despite that, the income tax growth was estimated to be around 14.4% on a Y-on-Y basis. So we were already looking at a possible shortfall there. At the same time, the corporate tax collections too look on the higher side, which are budgeted. So we do see almost close to 1 lakh crore worth of shortfall on the direct taxes. Now, to counter that, this 60,000 crore approximately, which is the higher than budgeted number on the dividend, is a good cushion that has come about for the government. At the same time, the excise duty hikes that happened some time ago, that too will be providing some cushion to offset the direct tax shortfall. So I think right now there is no extra headroom which is created. It is actually balancing the risks which were being generated on the fiscal side, especially in a relatively slowing economy. Where the tax shortfall could have increased much more.
Got that.
Yeah.
Okay, let me just ask Upasna if she broadly concurs with this. Upasna, your thoughts? Sakshi, your thought? What Upasna is indicating is that this basically just provides a cushion to counter the direct tax shortfall.
Yeah, I, kind of agree with that view. With this higher dividend announced, I wouldn't, be tempted to change my fiscal deficit, forecast for the year. I think the broad, issue is that the budget had kind of assumed 10% nominal GDP growth. But, with how inflation has been moving and the fact that real GDP growth is also, kind of expected to be lower this year, nominal GDP growth could come in, between 9.5%, which does present this downside risk to, the tax collection, growth that was assumed in the budget, what Upasna kind of referred to. So at this stage, I think given this, I wouldn't necessarily expect, a huge increase in spending because of this dividend transfer. Or, alternatively assume that the fiscal deficit could be lower than what the target currently is.
Okay, so, before we talk about policy, which is all set for next week, just wanted to get your sense. There was a lot of buzz out there, or I think just general anticipation that because of what's been happening at the border, the defense budget could be perhaps increased or maybe additional borrowing to shore up the whole replenishment demand. Very quick thoughts, ladies, from both of you on this front. So from what you're saying, the RBI cushion clearly cannot be used. It's not sufficient to increase defense spending in any way. But would you expect any other arithmetic or permutation and combination around this at all? Just quick thoughts on defense, and then we'll move on to the policy. Upasna?
Definitely there's talk about this, and there is a high probability that happens. Now, the question is, if it doesn't really happen through the course of the full year, then maybe the necessity of increase will not be as much. Basically, it will spill over into the next year's requirement as well. So we will see higher spending even into the next year. That is one. Secondly, there could be prioritization of spending. So it's not necessary yet that all spending is done across all segments. We might see reprioritization, and some defense spending increase could be offset by cuts in some other segments. So it's not yet a given. We are just in the beginning of the year, and I don't see too much of a risk of a fiscal slippage here at this point in time. Defense spending could increase, but it could come at the cost of some other reduced spending on other categories.
Okay. All right. And, your thoughts, Sakshi? Same question. Do you expect, first of all, slightly higher allocation to defense? And if yes, then where will the money come from?
I mean, it is a possibility that there could be an increase in spending on defense, and not just for FY26, but maybe this is the start of a shift in how much we are allocating to, defense capital expenditure, particularly over the medium term. Right? For this year's fiscal math, I think it is too early to kind of discern whether this would mean any fiscal slippage. Because as I highlighted earlier, there are just too many moving parts at this stage. I mean, we'll have to also see how GST collections, for instance, pan out. Are they higher than what the government had estimated? Because that's one space in the whole tax, basket, which has shown continuous, momentum. So, I mean, I think at this stage, I wouldn't necessarily take this as a threat to the fiscal deficit target. I think we'll have to just wait and watch for how things progress over the coming months.
Okay, so now let's talk about policy, which is all set for next week. Just before you joined us, we actually had a market expert talking about how he feels this is a golden age, perhaps for inflation in India, because the numbers have been trending lower. And some of the estimates are saying maybe in June itself, I mean, we could see, he was saying he expects 50 basis points. But your thoughts on what next from the RBI in terms of whether any additional liquidity measures, rate cuts? Sakshi?
My expectation is that the RBI is going to cut the policy rate, but it's going to be by 25 basis points. I do not expect a 50 basis point cut. I don't think that there is a need for the RBI to be that aggressive in this policy. I think it is true that inflation has been trending down, but at the same time, I think at least for the next 2 or 3 months, we'll have to very cautiously look at the monsoon progress and what is happening in terms of the distribution of rainfall, because that can be very precarious and you can get spikes or volatility on vegetables, etc. So I think the RBI perhaps will be a little, will kind of pace out its rate cuts. On liquidity, I do not expect them to come out with any new announcements. I think the RBI has already been very active in terms of supplying liquidity to the banking system. And I think that is something that they will kind of continue doing. I would estimate system liquidity to remain comfortably in surplus over the coming months.
Okay. All right. So 25 basis points and nothing new on liquidity, considering it seems to be fairly ample at this point. That's the view from HDFC Bank. Upasna, final thoughts. RBI next week, what are you expecting?
I would broadly agree. We're looking at 25 basis of a rate cut. Just to note that the dividend has increased the core durable liquidity and it's expected to continue to keep the core liquidity closer to 5 to 6 lakh crore. Now, that, of course, takes time to filter back once government starts spending aggressively back into the system. But having said that, at this point in time, we overall look at the banking system liquidity also more or less anchoring around 1% of NDTL on a surplus side. Now, which also means that there's no need really for RBI to do anything on the liquidity front. At this point, we expect 25 basis of rate cut. Probably monsoons will be important. So while for the Kharif crops, everything looks good because of early monsoon arrival. But of course, there will be some kind of disruption happening for the standing crops. So we will have to be watchful on that front. But having said that, I think overall, the trajectory for inflation looks very comfortable this year. We are looking at an average of 3.5%, and H1 is looking more averaging around 3%. Even if some kind of disruptions happen, I think it could still, have a 30-40 basis upside. Then, too, it is at sub 4%. So I think there is headroom for RBI to go ahead with rate cuts. Of course, they may want to pause in one meeting post the June policy and then look at the options open in the subsequent policies.
Okay. All right. Thank you very much, both, for being here with us. Important thoughts, and it sets us up very nicely for the policy next week. Sakshi and Upasna, thanks for joining in. Have a good day, both of you.